There is a specific moment in every serious trader's journey, a single, precise instant, when the market stops looking like random noise and starts making sense. Not partial sense. Not, I kind of understand what's happening sense. Complete, crystalline, unmistakable sense. For most traders, this moment never comes. They spend months or years staring at charts, accumulating indicators, following signals, and the market remains, despite all their effort, fundamentally mysterious. A chaos of red and green candles that occasionally cooperates with their analysis and more, often does not. For the traders who do reach that moment, the ones who eventually see what I am about to show you, everything changes. Not just their results, their entire relationship with the market. The anxiety of uncertainty gives way to a calm, confident reading of what is actually happening and why. I remember the exact moment it happened for me. I was staring at a chart I had looked at hundreds of times before, and suddenly I saw it. A pattern so clear, so logical, so deeply embedded in the structure of how markets actually move, that I could not believe I had missed it for so long. I went back through months of charts. It was everywhere, on every asset, on every time frame, hidden in plain sight, repeated endlessly, governing the movement of price in a way that, once you understand it, makes the market feel less like gambling and more like reading a book you have read before. This is that pattern. And I promise you, once you see it, you will never look at a chart the same way again. First, why most traders never see it. Before revealing the pattern, we need to understand why it remains invisible to most traders, even experienced ones. The answer is surprisingly simple. Most traders are looking at the wrong thing. When a new trader opens a chart, their attention immediately goes to the indicators, the moving average lines, the RSI at the bottom, the MACD, the Bollinger Bands. They are looking for signals, external confirmations that tell them what to do. This focus on indicators creates a fundamental blindness to what the price itself is communicating. And price, raw, unfiltered, indicator-free price action, is the only source of truth in any market. Everything else is a derivative of it. The pattern I am going to show you is not an indicator. It cannot be generated by any algorithm or detected by any automated system. It requires you to look at price directly, to read it the way you would read a face, or a body of water, or any other system that communicates through movement and behavior. Once you develop that ability, the indicators become secondary, useful for confirmation, but no longer necessary for understanding what the market is doing. This is the shift. This is the door you are about to walk through. The pattern, market structure. The pattern is called market structure, and it is the single most important concept in all of technical analysis. Here is the pattern in its simplest form. Markets move in waves. Every trend consists of impulse moves in the direction of the trend, followed by corrective moves against the trend. These waves create a specific sequence of highs and lows, and that sequence tells you everything. In an uptrend, higher highs and higher lows. In a downtrend, lower highs and lower lows. In a range, equal highs and equal lows. That is the entire pattern. 3 sequences of price behavior that describe every market condition that has ever existed, or will ever exist. I know what you are thinking. That sounds too simple. I already know about trends. You know about trends conceptually. What I am about to show you is how to read market structure in real time, how to see these sequences forming as they happen, how to identify exactly where the trend is strong, where it is weakening, and where it is about to reverse. This is what separates traders who consistently profit from those who do not. Part 1. Reading an uptrend through structure. Let's start with the uptrend, because it is the most intuitive. In a healthy uptrend, price moves in a consistent pattern. It rises to a new high, impulse move, pulls back to a higher low than the previous low, correction, then rises to an even higher high, next impulse. Each high is higher than the last. Each low is higher than the last. This sequence, higher high, higher low, higher high, higher low, is the fingerprint of a bull market. Now here is where market structure becomes actionable. When you see this pattern playing out clearly and consistently, The trend is healthy and strong. The appropriate strategy is to buy the pullbacks, to enter long positions when price pulls back to a higher low level and shows signs of resuming upward. But here is what most traders miss. The pattern tells you when the trend is ending before it ends. The first warning sign is a failure to make a new higher high. Price attempts to break above the previous high, runs out of momentum, and turns lower without exceeding it. This is called a lower high, within what was previously an uptrend, and it is the first structural warning that buying pressure is fading. The confirmation of trend change comes when price breaks below the most recent higher low. This is called a break of structure, and it is the single most important event on any chart. When the most recent higher low is broken, the uptrend's structural integrity has failed. The market is telling you, through its own behavior, that the balance of power between buyers and sellers has shifted. This is not an indicator signal. It is the market itself communicating. Part 2. The break of structure, where money changes hands. The break of structure is the moment that separates profitable traders from losing ones, and once you know what it looks like, you will see it on every chart you ever look at. Let me describe it precisely. In an uptrend, every pullback creates a swing low, a point where price temporarily stops, declining, and reverses upward. In a healthy uptrend, each of these swing lows is higher than the previous one, higher lows. These swing lows represent the buyers defending the trend. When price breaks below one of these swing lows, when it slices through a level that buyers had previously defended successfully, that is a break of structure. The buyers who held the line at that level are now losing. Their defense has failed. What happens immediately after a break of structure is critically important. Often, price will return to the broken level, the level that was previously support, and test it from below. What was support is now resistance. This is called a retest, and it is one of the most reliable and high-probability trade setups in all of trading. At the retest, previous buyers who held this level are now in losing positions. They will often exit, sell, when price returns to their entry, adding selling pressure at the retest. New sellers who recognize the break of structure will add to their positions at this level. The combination creates a high probability rejection of the retest level. This is not theory. This is the mechanical behavior of market participants, the human actions of thousands of traders, aggregated into a single price level that now has a clearly defined meaning. When you see a break of structure, followed by a retest of the broken level, you are watching money change hands in real time. And if you know what you are looking at, you can be on the right side of that exchange. Part 3. Market structure in different conditions. The ranging market. When market structure shows neither consistent higher highs and higher lows, nor consistent lower highs and lower lows, you are in a range. Price is oscillating between two relatively equal levels, a resistance zone at the top and a support zone at the bottom. In a ranging market, the appropriate strategy is to buy at the bottom of the range and sell at the top, or simply to wait. Trend-following strategies, moving average crossovers, and momentum indicators all fail in ranging conditions because there is no sustained trend for them to follow. Market structure tells you immediately when you are in a range, and equally immediately when scanned, the range is ending. A break of structure above the range's resistance level signals a potential upside breakout. A break of structure below the range's support signals a potential downside breakdown. The trend transition. The most powerful and most profitable moment in any market is the transition from a downtrend to an uptrend, or vice versa. And market structure is the only tool that can reliably identify this transition in real time. Here is what a downtrend to uptrend transition looks like through the lens of market structure. The market is making lower highs and lower lows. Then, for the first time, price makes a higher low. It pulls back but does not go as far down as the previous low. Then it rallies and breaks above the most recent lower high. This is the break of structure to the upside, the first structural evidence that the downtrend is ending. This moment, the break of structure above a lower high in a previously downtrending market, is where the best risk-reward trades in all of technical trading are found. You are entering as close to the actual trend change as it is possible to identify. Your stop loss is tight, just below the recent higher low. Your potential profit is enormous, the entire new uptrend. Part 4. How to trade market structure. Step by step. Now that you can see the pattern, let's talk about how to trade it. Step 1. Identify the current market structure. Open your chart. Remove every indicator. Look only at price. Ask yourself, is price making higher highs and higher lows, lower highs and lower lows, or is it oscillating between equal levels? This single assessment tells you the current market regime and which strategies are appropriate. Step 2. Identify the most recent structural level in an uptrend. Identify the most recent higher low. This is your key level, the point that the trend must defend to remain intact. In a downtrend, identify the most recent lower high. This is the ceiling that price must stay below for the downtrend to continue. Step 3. Watch for a break of structure. If price breaks below the most recent higher low, in an uptrend, a break of structure has occurred. Alert mode. The trend may be changing. If price breaks above the most recent lower high, in a downtrend, a break of structure to the upside, watch for the beginning of a reversal. Step 4. Wait for the retest after a break of structure. Wait for price to return to the broken level. This retest is your entry opportunity. The moment where the broken level, new roll, former support becoming resistance, or vice versa, is confirmed. Step 5. Enter on confirmation. At the retest level, look for a confirming candle, a rejection wick, a bearish engulfing, or any pattern that shows price being rejected at the retest level. Enter on the close of the confirmation candle. Step 6. Define your risk. Place your stop loss on the other side of the retest level. If you are shorting a retest of broken support, now resistance, your stop goes above that resistance level. If the market trades above it, your thesis is wrong, and you exit with a controlled loss. Step 7. Target the next structural level. Your take-profit target is the next significant structural level in the direction of your trade. In a new downtrend, target the next area of support. Let price travel the full distance between structural levels. Do not exit early simply because you are in profit. Part 5. Why this pattern works. On every time frame and every asset market structure is not a down strategy invented by a trader or a pattern discovered by a researcher. It is a description of how markets behave, driven by the collective psychology of every participant in that market. On a 1-minute chart, market structure reflects the decisions of day traders and scalpers. On a daily chart, it reflects the decisions of swing traders and institutional funds. On a weekly chart, it reflects the positioning of the largest players in the market, the pension funds, the sovereign wealth funds, the central banks. But the pattern is the same at every level. Higher highs and higher lows, lower highs and lower lows, breaks of structure, retests. The same sequence, repeated across every time frame, on every asset, in every market that has ever existed. This universality is why market structure is the most powerful tool available to any trader. It works on stocks. It works in currency markets. It works in commodities. It works in cryptocurrency. It works in futures. It works wherever there are buyers and sellers, because it is simply a description of what buyers and sellers do when they interact. Conclusion. You cannot unsee this. I promised you at the beginning of this article that once you saw this pattern, you would never look at a chart the same way again. Open any chart right now, any asset, any time frame. Look for the sequence of highs and lows. Identify whether they are higher, lower, or equal. Find the most recent break of structure. See where the retest occurred. It is everywhere. It has always been everywhere. The market has been communicating this information continuously, on every chart, every day, and now you can read it. This is the shift that separates traders who consistently lose from traders who consistently profit. Not a better indicator, not a more sophisticated strategy. The ability to read what the market is actually saying through its own price behavior, and to act on that reading with discipline and patience. The pattern was always there. Now you see it, and you will never unsee it. Drop a comment. Can you see the pattern on your charts now? Tell me what you found. The market is always communicating. Most traders just don't speak the language. Every